Hi, I'm David Freitas. I'm a reporter at GlobalCapital.
And I'm Bill Thornhill. I work as editor for Covered Bonds.
And we're going to talk a little bit about covered bonds and how they have been performing in the market. So, Bill, thank you for joining us today. So, in the past couple of weeks, covered bonds have had a good run-up. And can you talk to us a little bit about that?
Yeah, we had a good start to the year, but then 2 or 3 weeks ago, coronavirus fears started to weigh in on sentiment. And since then, it's got really bad. Equity markets have tumbled a lot. Spreads have started to widen in core markets up to 3 or 4 basis points in the secondary and double that in the periphery markets. But when you consider how that compares to senior unsecured, it's a fraction, where we've seen spreads widen, 40 basis points or more in senior holdco bonds. That's quite substantially a lot more.
Why is that there is such a discrepancy between, for example, senior bonds and covered bonds then?
Well, part of the reason is the fact that you've got so much protection, but in covered bonds, obviously, the famed dual recourse protection, but also you've got the central bank there buying and stabilising the market, the ECB buying covered bonds, so it's naturally supported by central bank intervention, as well as being obviously a fundamentally lower credit risk.
What can you tell us about how the situation in Italy has contributed to the covered bond performance?
Yeah, so Italy has underperformed the worst by far, but having said that, it's done okay. When you look at secondary spreads, the proper test is going to be when a primary deal comes, and so far so good. Italy, what we've seen so far is that there's been a moratorium on mortgage payments nationwide. That was declared this week. So essentially that means, the payments that are coming into banks' books for mortgages could be disrupted. That shouldn't affect the outgoing payments on the mortgage covered bonds, because the banks themselves are liable for those payments, so they will make up the shortfall. Also, covered bond programs have a couple of measures in them which stops payment disruption. One's a liquidity reserve, which covers for 180 days. Another is the soft bullet 1-year extension. So when you put those things together, in theory, everything should be okay. However, having said that, there are a couple of regions up in the north, Lombardy, Venice and Emilia-Romagna are the most affected regions in Italy. Now, the cover pools of BIPIM and BIPA are 50%, at least 50% concentrated in those 3 regions. Those 2 banks are probably going to feel the real heat when it comes down to potential disruptions in payment, but we'll see what happens.
What can you tell us about primary market issuance and the lessons that it has taught us?
Well, today we had Bank of Nova Scotia in the market. Typically, Bank of Nova Scotia likes to issue large deals. They haven't yet announced the deal size, but I suspect they'll do $1 billion. The fact that they've managed to do that in the 5-year, only 2 days after what some are now calling Black Monday, is a feat in itself. So that's pretty good. On the other hand, they started with 12 basis points new issue premium versus indicative secondary levels, and they've ended up at 10. The problem there is secondary market levels aren't really to be trusted, as bonds are trading more now on the bid than on the mid. So the actual premium, if you look at the bid side, is probably closer to 7 or 8 basis points, which is similar to what Commerzbank paid for a 1.25 billion 10-year issue previously.
Any other developments, any other issues?
We've seen a 5-year transaction from Luminor Bank, which was the first Baltic transaction to be issued, the first off the Estonian covered bond law. It went very well. It was 3 times oversubscribed. It shows there's a degree of confidence in the Estonian law. It also allows Luminor Bank to start funding itself, which is great news, because it doesn't therefore need to rely on parent funding, which was coming from DNB and Nordea. And that means DNB and Nordea should theoretically be able to sell their remaining 40% stake back to BlackRock.
What lessons can we take from these deals and the state of the markets in the past couple of weeks?
So I guess the lesson is that, issuers need to be practical. The strong conditions that we've seen up until 2 weeks ago are clearly not there. Deeply negative yields means that issuers are now going to have to start paying up in terms of new issue premiums. Issuers with fixed ideas of what their new issue premiums is going to be are probably going to come unstuck. They need to go in with a very flexible and open attitude, and I imagine wider new issue premiums will end up causing a repricing of the secondary market, which for the time being seems to be relatively well contained.
What can you tell us about performance in the dollar market?
So dollar market has provided some interesting funding opportunities for UK issuers. Specifically, we saw Nationwide Building Society and Santander UK coming with 2 3-year 144A covered bonds earlier this year. Those transactions will have refinanced the money that they borrowed from the Term Funding Scheme. The Term Funding Scheme, we found out today, has now been renewed by the Bank of England. So it's possible that UK banks that had borrowed from that will simply roll it into the new TFS. Although from what I understand, the new one is slightly more restricted. It's for SMEs. So it's possible anyway that the UK banks will, in any case, do some more dollar-covered bonds. The interesting thing about this was that they haven't been in that market in 144A format for over 10 years. So it was a big thing for them to be doing. They got a big saving versus senior unsecured, and also they changed the extension slightly, so now it's referenced against SOFR, the alternative to LIBOR, as opposed to LIBOR. So yeah, there was a few innovative things about those transactions, but whether they repeat them or not in light of the new facilities that have been offered by the Bank of England, I don't know.
And you've mentioned the Bank of England with new stimulus, and we're expecting the European Central Bank to come out as well on Thursday. How do you think that's going to impact covered bonds?
So we're already down to rates levels which are below the levels were last seen in September, the lows that were seen in September last year. At that time, we saw a handful of deals struggle. At least 3 were undersubscribed. The new issue premiums at the time were fairly limited. I would guess that as yields fall further, new issue premiums will need to rise. And I suspect issuers will need to take a very, very flexible attitude on that. And as new issue premiums rise, it'll reprice the secondary market. I think the biggest concern that I have is that the ECB runs out of collateral to buy. They're potentially going to raise the asset purchases from 20 billion a month to 30 billion a month. As it was at 20 billion a month, they were going to run out of collateral anyway. They need to raise the limit on the sovereign purchases from currently capped at 33%. If they don't raise that limit and they can't get political cover to raise that limit, then their easiest option will be for them to buy more covered bonds and corporate bonds probably. That'll squeeze out private investors and mean that the secondary levels are more artificial than they would be otherwise, which would also mean that new issue premiums would have to be even larger than they are potentially going to be anyway.
And finally, how do you see this asset class panning out over the next few weeks?
Well, I mean, compared to other asset classes, i.e. in the unsecured market, it theoretically is the rainy day product. Let's see if it lives up to its name. I suspect it will for big names, for national champions, but I question the ability of smaller issuers to be able to access this market, especially from regions which have been heavily affected by the coronavirus. So we'll just have to wait and see.